Gold is having a moment. The buying price of gold futures has hit multiple record highs this year. Since January 2nd, it's risen more than 14% in value. That's more than the Dow Jones, NASDAQ, and S&P 500, which have also hit record highs. Gold has historically been viewed as a safe investment because for centuries people have treated it with intrinsic worth, less influenced by the passions of the moment. The last times it peaked were following the 2007 to 2009 financial crisis and after the onset of COVID-19. But gold's current rally is happening without a recession or a pandemic, and inflation and interest rates are both expected to fall. So what is behind the gold rally? Here to explain is Campbell Harvey. He's a professor of finance at Duke University and co-author with Claude Erb of The Golden Dilemma. Thank you so much for being with us. Who's buying the gold?
So it's very interesting. You would think that retail investors are piling into gold. And the usual way that you would invest in gold is to buy an ETF. But that's not really the case. If you look over the last 10 months, there have been like negative flows or outflows from the gold ETFs, and actually an increase in the Bitcoin ETFs. So this is, in my opinion, mainly institutional investors like hedge funds that are speculating on the price of gold. As you mentioned, gold has done well over the last quarter, but over the last year, it's lagged the S&P in spectacular investments like NVIDIA and others. So I do think that people saw gold as lagging, and the institutional investors are piling in.
Now, Professor, can you help us remember, or maybe even learn it for the first time, what an ETF is?
Yeah, so an ETF, to buy gold is complicated. So yes, you can go to a store like Costco and buy like a small gold bar, but it's an issue in terms of the security of that gold. So to actually hold gold at your house is risky and is costly to warehouse it in general. So instead, what people generally do is to buy an exchange-traded fund, which is like a cheap version of a mutual fund. And you buy a share of that, and the fund actually warehouses the gold for you.
Okay. So it's a note saying somewhere off you've got some bar of gold that's got your name on it, or a sliver of that bar of gold. What about that relationship that we mentioned in the introduction between gold and kind of shaky times? Is that still the way people think about gold, and how then does that match up with what you were saying about the purchases being done here by hedge funds?
So the traditional rationale for gold is that it provides like a crisis hedge or an inflation hedge. But my research with Claude Erb that uses like thousands of years of data for gold provides a counterpoint. And that is that gold is pretty volatile. So its movements up and down can be very sharp, indeed as sharp as the S&P 500. Which means that it's somewhat unreliable in terms of that ability. And yes, it is true that just before or during the COVID crisis and the global financial crisis, we saw some movement up in the price of gold, but then it dropped sharply. So it is unreliable. And I do think that this is more institutional investors playing what we call a momentum trade. And that means as the price is going up, you buy more. And when that happens, you get this momentum until it stops and it turns around. So like I know gold is at an all-time high, and my research also looks at, well, what if we buy gold at all-time highs and look at that historically? And historically, if you buy at the all-time highs, the expected returns over the next 10 years are quite modest.
Professor Campbell Harvey from Duke University, thank you so much.
Thank you.